Good morning, my name is Gianluca Santi and I'm the General Manager of Business Development and Corporate Communication of the Unipol Group. The results of the past 9 months have been very good, despite the ongoing economic turbulence. Let me start reminding you once again that last year Unipol booked the first impact of beeper consolidation and the effect of the Solidarity Fund. Therefore, the 19 results are normalized to exclude these two non-recurring items and to ease comparison with the current results. Unipol pre-tax profits showed an increase to 939 million in the first 9 months 20, from 796 million last year, driven by a strong performance of the non-life sector. The decrease in the result of the life sector was mainly due to the negative contribution of the financial component, while the result of the holding and other sector was largely impacted by the unfavorable performance of hospitality business. The consolidated net profit was 759 million for Unipol, 577 million this time last year, and 701 million for UnipolSai, 576 million last year. Total non-life premiums decreased by 3.6% year-on-year to 5.5 billion. Motor premiums fell by 4.6%, while non-motor by 2.6% compared to this time last year. Looking at the three ecosystems, mobility recorded a minus 4.1%, welfare a minus 3.3%, and property a minus 2.7%. No significant changes to point out in the distribution channels, where 81% of the group premiums were sold by the agency network, 12% by brokers and end office, 3% by bancassurance, and 4% by direct and other channels. Combined ratio after reinsurance was 86%, a significant improvement over last year, including a 6.6 percentage points impact from atmospheric events and heavy losses. It should be noted that last year, reinsurance offset a considerable part of the impact of weather events, while this year it covered a minor part of the losses. Combined ratio from direct business stood at 85.5%, with an effect of 6.9 percentage points from atmospheric events and heavy losses. Motor business is still benefiting from the positive trend in frequency, but at the same time it still suffers from a long-time decrease in the average premium. On the life side, total premiums declined by 27.2% to 3.1 billion, due to the economic crisis, but also to the group strategy, which aims to limit life yields dilution. Let me also remind you that last year production included a one-off item linked to the pension funds for over 600 million euro. Hybrids, consisting of a traditional and linked component, continue to represent a considerable portion of the group production. Unit-linked recorded excellent performances with a growth of almost 40% year-on-year. In terms of live yields, allow me to draw your attention to the slight drop in the average segregated accounts yield, which is the result of changes in the asset allocation, aimed at reducing risk in the financial portfolio. Even so, the gap between the average and minimum guaranteed yield on segregated accounts remains sound and steady at 208 basis points. The guaranteed yield across the backbook is slowly declining, with most new products sold with a 0% minimum guarantee. Total investments were 60.4 billion at market value. In terms of asset allocation, the group has been pursuing a strategy of reducing Italian BTP and equity exposure in favor of euro area core govies, high-rated corporate credit and real assets. Consequently, Italian Govies weighed 42.9% of total investments at the end of September, compared to 50.1% at the end of last year. Financial yields from the insurance activity remain solid, with an overall running yield of 3%. The duration of assets was 6.8 years, 3.4 in non-life and 8.4 in life. The total value of the real estate portfolio stood at 3.9 billion, of which 57% allocated to the real estate sector, 34% to non-life, and the remaining part to life and other sectors. No write-downs were booked in the first 9 months of this year. As for the NPE business, the first 9 months of the year recorded a gross loan reduction of 277 million, with collections for 80 million and a satisfactory recovery rate always around 30%. 453 million was the amount of net bad loans, covered at 86%. Profit for the period was 4.7 million. In terms of solvency, the ratio at Unipol and UnipolSai improved further compared to the figure of the first half. Unipol reached 193%, UnipolSai consolidated ratio was 258%, and UnipolSai solo 284%. That brings me to the end of my presentation. Thank you for listening. I remind you that our Group CEO and General Manager will be pleased to take any questions from financial analysts and institutional investors during the conference call scheduled today at noon CET.